You've seen the picture, right? The one from Wall Street with that massive bronze bull, head down, horns up, looking like it's ready to charge. Well, that's way more than just a statue. It's this powerful symbol of financial optimism and really economic strength. But what does it actually mean when you hear people say the market is a bull?
So, here's our game plan. First, we're going to nail down exactly what a bull market is. Then, we'll pop the hood and see what makes it run. After that, we'll get into the playbook, how investors actually try to ride that wave. We'll also cover the hidden dangers, because there are always risks. And finally, we'll tie it all together with the one big idea you need to walk away with.
All right, let's dive right in and start with the absolute basics.
So what are we really talking about when we say bull market? At its heart, it's a time when asset prices, we're talking stocks, real estate, you name it, are on a sustained upward climb. This isn't just a good day or a good week. It's a long, steady tide that's lifting pretty much all the boats, and it's all fueled by real optimism and a genuinely strong economy.
And you might be wondering, why a bull? Well, the whole idea probably comes from the way the animal attacks. A bull thrusts its horns up, just like a rising market. And the opposite? That's a bear market, which comes from a bear swiping its paws down, signaling falling prices and a whole lot of pessimism. It's a really simple visual, but man, is it effective for capturing the market's mood.
Okay, so we know what it is, but why does it happen? What are the gears turning behind the scenes that get this whole engine revved up and keep it pushing higher and higher?
Now, while there's no official alarm that goes off, this is the benchmark you're going to hear about most often. A bull market is usually declared when a major market index, think the S&P 500, climbs 20% or more from its most recent low. It's not some magic number, but it's the widely accepted sign that, yep, a major positive trend is officially underway.
A bull market doesn't just happen in a vacuum. It's really a mirror of a healthy, humming economy. And you can see how it all connects. The GDP is rising, so the whole economic pie is getting bigger. That means unemployment starts to fall. When more people have jobs, they spend more money, which in turn boosts corporate profits. And when investors see all this good news, their confidence soars. And that optimism itself pours more fuel on the fire. It's a really powerful positive feedback loop.
And trust me, these bull runs are nothing new. They're a reoccurring chapter in our economic story. You can see the pattern throughout history, from the wild speculation of the roaring 20s to the policy-driven 80s to the tech-fueled dot-com boom of the 90s. And of course, there is the absolute monster bull market that ran for more than a decade after the 2008 financial crisis. Each one has its own flavor, but they all share that same core DNA of economic growth and sky-high optimism.
Okay, so we've got a handle on what a bull market is and what drives it. But how do investors actually try to make the most of it? Let's open up the playbook and see.
There are a few main ways people approach this. The classic strategy is buy and hold. It's simple. You invest for the long term and just let that rising tide do its thing. A little more hands-on is buying the dip, where you see any short-term price drop as a chance to buy more. And then you've got the high-octane approach, full swing trading, where traders are constantly jumping in and out of positions to squeeze out every possible gain.
And beyond those main strategies, you start getting into more advanced tools. And this is where things get tricky. You have methods like dollar-cost averaging, which helps smooth out your entries over time. Or you can focus on hot growth sectors like tech. Then you have the really complex stuff like options or leverage trading, which lets you control big positions with less cash. But here's the critical thing to remember. While these can amplify your gains, they can just as easily and just as quickly amplify your losses. They are definitely not for beginners.
And that brings us to a super important point. A rising market feels incredible, but that very optimism that fuels it can also create some major blind spots. Staying smart and managing your risk is every bit as important as chasing those returns. This quote just perfectly captures the psychological trap. Irrational exuberance. It's when the sheer excitement of the moment makes people forget about fundamentals. They start buying things at crazy high prices or taking on way more risk than they normally would, all because they think the party will never end.
So what are the big traps to watch out for? Well, it usually starts with overconfidence. After months or even years of gains, it's so easy to feel like a genius and take on way too much risk. When everybody starts doing that, it can create market bubbles where prices get totally disconnected from reality. And that leads to the impossible challenge of market timing. Everyone fantasizes about selling at the absolute top, but trying to nail that perfect moment, it's a fool's errand that almost always ends in regret.
So what are some smart things you can do? Here are 3 really practical ideas.
First, rebalance your portfolio. This just means selling a bit of what's done really well to lock in some of those profits and get your risk level back to where you're truly comfortable. Second, use the strong job market to beef up your emergency savings. And third, think beyond your investments. Plan your next career move. It could be the perfect time to ask for that raise or look for an even better job.
All right, we have covered a ton of ground. Let's zoom out and put all these pieces together into one clear final idea.
When it all comes down to it, this is the main takeaway. Bull markets are a totally natural, incredibly powerful part of the economic cycle. They present huge opportunities to build real wealth. But, and this is a big but, they aren't risk-free. The very optimism that makes them so great can lead you into big mistakes, which is why having a disciplined, level-headed plan is always your best strategy.
And that really brings us to our final and maybe the most critical question. Because if there's one thing history makes crystal clear, it's that bull markets do not last forever. The bull eventually gets tired and the bear wakes up. The goal isn't to be afraid of that change, but to be prepared for it. So the question I want to leave you with is, are you? Thank you for watching. If you got something from this, please like the video and support the channel by clicking on the subscribe button. That really helps us. Thanks again.